You know that feeling when you walk into a property that's been just aggressively staged for a quick sale?
Oh yeah, like the fresh baked cookie smell and everything.
Exactly. Like the recessed lighting is perfectly calibrated, the walls have that pristine coat of modern gray paint, and the furniture just looks immaculate.
Right, on the surface, the place looks totally flawless.
Flawless. But then, you step down into the basement, you shine a harsh flashlight into the dark corners, and you see the actual reality. The foundational concrete is just spider-webbed with massive structural cracks.
The house is actively sinking.
Right. The house is sinking. That fresh coat of paint upstairs is just a psychological trick, entirely designed to distract you from the catastrophic structural failure happening directly beneath your feet.
I mean, it serves as the ultimate architectural illusion, The seller is pitching you this surface-level aesthetic while demanding you completely ignore the underlying physics of the actual structure.
And for you, our listener, someone who routinely cuts through all this financial noise to understand the actual granular mechanics of the global economy, well, that level of basement-tier structural inspection is exactly what we're undertaking today.
Yeah, we're definitely bringing the harsh flashlight today.
We really are. So it is late June 2026. And the stack of sources we're parsing through today is intensely heavy. I mean, it reads far less like a standard economic white paper and much more like a forensic financial autopsy.
Or honestly, in some places, it reads like a whistleblower's manifesto.
Yeah, totally. We are analyzing translated, strategy-focused documents dissecting what the authors term the macroeconomic anatomy of the U.S. Federal Reserve and the broader global debt system.
And these documents offer this raw, entirely unfiltered teardown of the mathematical realities that are currently underpinning global liquidity and sovereign debt. It's a very cynical, yet highly mathematically rigorous perspective on exactly where we're heading.
But before we go a single step further, I need to pause and establish a definitive ground rule for this deep dive.
Yeah, this is super important.
Right. So the sources we're exploring today contain highly charged, heavily anti-establishment, and intensely controversial economic viewpoints. The authors use aggressive language, and they paint a deeply pessimistic picture of global financial institutions.
Very pessimistic.
So I want to make it unequivocally clear to you listening that neither of us here is taking a side. We are absolutely not endorsing these views, nor are we offering financial advice of any kind.
No, not at all. We are simply acting as your impartial guides here.
Exactly. Our sole objective today is to unpack the complex, often fascinating mechanisms argued within this source material so you can evaluate the thesis for yourself.
Because, knowledge in this space requires stress testing the consensus, examining perspectives that actively attempt to dismantle the prevailing narrative. Well, that's really the best way to test the strengths of your own macroeconomic models.
Okay, let's unpack this and get straight into the core premise. The documents suggest that the mainstream media's relentless narrative of an economic soft landing, that fresh coat of paint we just talked about,
Right.
is actually a carefully engineered illusion. The sources refer to it as the shiny roof.
I love that term, the shiny roof.
Right. It's a facade constructed to camouflage a multi-trillion-dollar mathematical trap. So what is this trap?
Well, the foundational argument here is that the Federal Reserve is no longer in the business of managing an economy.
Okay.
They're exclusively managing a $34 trillion U.S. national debt bomb. And to grasp the velocity here, the text highlights that this debt is currently expanding at a rate of $1 trillion every 100 days.
Wait, 1 trillion every 100 days?
Every 100 days. The acceleration is the critical factor here.
That's just wild.
It is. And when debt expands at $1 trillion roughly every 3 months, the central bank finds itself caught in what the authors call the mathematical pincer.
A pincer, like a trap with two jaws.
Exactly. It's a trap with two mechanical jaws closing in, which renders traditional monetary policy completely inert. Let's look at the mechanics of the first jaw, which is cutting interest rates.
Right, because we constantly hear the financial media forecasting rate cuts. TV experts pushing the narrative that a return to cheap liquidity is imminent.
Yeah, they talk about it all the time. But the sources argue that this anticipation is a fatal trap.
Why?
Because if the Fed cuts rates, they compress the yield on Treasury bonds. And when those yields drop, the U.S. debt loses its primary mechanism for attracting the massive inflows of foreign capital required to roll over the expiring debt.
Oh, I see. So if the U.S. can't offer an attractive premium on its debt, the buyers just vanish.
They simply vanish. The authors predict this would trigger what they call the Great Capital Flight.
The Great Capital Flight.
Right, because sovereign wealth funds and big institutional players, they don't operate on loyalty.
Right, they operate on yield and security.
Exactly. If rates are slashed in this inflationary environment, those massive pools of capital will instantly migrate out of the US dollar and rotate into hard safe havens.
Like physical gold, I assume.
Primarily physical gold and strategic resources, yeah. And without that constant influx of foreign capital to absorb the new bond issuances, the US Treasury option fails. The sovereign debt cycle just seizes up instantly.
Wow. Okay, so that presents a massive problem for all those rate cut cheerleaders on TV. But keeping rates elevated or pushing them higher, that triggers the second jaw of the pincer, right?
Yes, what's fascinating here is the flip side of that exact scenario. If the Fed holds rates high to maintain that yield premium and prevent the capital flight, the math simply turns inward and cannibalizes the Treasury itself.
Because of the interest payments.
Exactly. With $34 trillion in principal, the cost of servicing the net interest alone becomes mathematically unsustainable. I mean, the documents project that this interest expense will soon permanently eclipse the entire U.S. defense budget.
That is staggering. It eclipses the defense budget.
It does. The net interest basically transforms into a localized black hole, consuming all incoming federal tax revenue.
So if tax receipts can only cover the interest on historical debt, the government is just mathematically unfunded.
Mathematically unfunded. So to maintain basic civic operations, the Treasury and the Fed are forced into a regime of infinite covert monetization.
Meaning they just have to constantly print the shortfall?
You must continuously print it.
Which perfectly explains the terrifying statistic the authors zero in on, core inflation anchoring dangerously at 4.7%.
Right.
Because if you're forced to flood the system with newly minted currency just to cover sovereign interest payments, you are systematically diluting the purchasing power of the existing supply.
It's basic monetary physics. The sources argue this creates a feedback loop that risks unleashing the hyperinflation monster.
The hyperinflation monster.
Yeah, you cannot exponentially expand the monetary base without a corresponding expansion in economic output and expect the currency to actually retain its purchasing power.
But let me challenge the premise here, though, just for a second.
Sure, go ahead.
We just outlined a dual-sided catastrophe. If cutting rates causes a sovereign rollover crisis and holding rates causes hyperinflationary debt monetization, why is there no broad market panic?
Right.
I mean, we boot up our trading terminals and the markets are near all-time highs. How does this impending systemic failure coexist with the current market exuberance?
Well, the authors answer that contradiction with the architectural analogy we touched on earlier.
The shiny roof versus the paralyzed feet.
Exactly. The shiny roof is the coordinated public relations filter.
Okay.
The mainstream financial media is deployed to broadcast this unrelenting narrative of resilience, disinflation, and tech-driven productivity growth.
And the objective, according to the text, is to keep the general public, whom the authors really derisively label the NPC crowd, fully invested in overvalued paper theaters.
They want retail capital locked into high-beta tech stocks and historically overpriced residential real estate.
Because the institutional elites require retail liquidity to remain in the matrix, so they have an exit mechanism.
That's the key. You cannot liquidate massive institutional positions without a corresponding bid from the retail sector. They need someone to buy what they're selling.
And the sources cite a fascinating, highly specific example of this alleged market manipulation. They point to a recent event where an entity, like SPDR, dumped 17 tons of paper gold onto the market.
Yeah, 17 tons?
Which is massive. And if you flood the order books with that volume of synthetic supply, you inevitably trigger algorithmic stop losses and drive the spot price down.
Right, and then the retail market panics at the sudden drop and liquidates their positions.
Exactly.
But while the spot price is synthetically suppressed by the derivative dump, those same institutional players are quietly stepping in to accumulate actual physical bullion at a steep discount.
Wow.
It's a masterclass in misdirection. They utilize the shiny roof narrative to keep retail chasing paper returns, while the smart money secures foundational assets through the back door.
Here's where it gets really interesting, though, because the contrast becomes incredibly stark when you look below that roof at what the sources call the paralyzed feet.
Right, the actual productive layer of the economy.
The small and medium enterprises, the SMEs that actually generate employment and localize GDP, they're facing a lethal convergence of macroeconomic headwinds.
The foundational pillars of the economy are just fracturing. I mean, on one front, these businesses are battling entrenched structural trade deficits and surging import costs that just compress their operating margins.
Yeah, everything required to run the physical business simply costs more.
Exactly. And then on the other front, because the Fed is trapped in that higher for longer posture to defend the bond market, the cost of capital is completely out of reach.
Right, these businesses are systematically starved of the liquidity they need to bridge those compressed margins. They literally cannot refinance their operational debt at these elevated rates.
And the documents describe this as a structural inevitability. You cannot maintain a stable macroeconomic superstructure when the foundational corporate layer is entirely deprived of affordable credit. No, the mathematics of sustained high rates dictate a massive, unavoidable explosion in NPLs.
Non-performing loans.
Yes, and as these businesses fail to service their debt, the contagion moves onto the balance sheets of the regional banks, which initiates an automated sequence of financial self-liquidation.
Jeez. Well, let's pivot to the global implications because there is a glaring contradiction here I want to dissect.
Okay, what is it?
If the U.S. is forced to print infinite money to service its debt, traditional currency models suggest the dollar should be depreciating rapidly against emerging market currencies.
Right, normally.
Yet the sources argue the exact opposite. They claim the Fed's higher for longer strategy turns the U.S. dollar into a global liquidity black hole. How do those two mechanics actually reconcile?
If we connect this to the bigger picture, they reconcile through the weaponization of the yield differential.
Okay, explain that.
The Federal Reserve is leveraging the global reliance on the dollar. By holding U.S. interest rates higher than the rest of the world, they force global capital into a ruthless survival of the fittest algorithm.
Oh, I see.
Yeah, despite the internal inflation, the nominal yield on U.S. Treasuries is so attractive that it aggressively vacuums capital out of emerging markets.
So institutional investors basically pull their liquidity out of developing nations just to chase that U.S. yield,
Exactly.
which leaves those emerging markets entirely stripped of their foreign exchange reserves. The U.S. essentially exports its liquidity crisis to the rest of the globe to fund its own deficit.
And the resulting distortions in localized economies are just severe. I mean, the documents highlight a highly anomalous situation occurring right now in mid-2026.
Yeah, I saw this part.
In certain domestic markets, the official commercial bank exchange rates for the dollar have actually surpassed the informal black market rates.
Which, under any standard economic model, is an absolute absurdity.
It makes no sense normally.
Right. The black market invariably demands a premium due to scarcity and regulatory risk. If the official rate is higher, the banking sector is essentially admitting systemic panic.
Yeah, the authors analyze this inversion as a deliberate, aggressive institutional algorithm. The domestic banking system is terrified of the capital flight we just discussed.
So they're overcompensating.
Big time. By artificially pushing the official exchange rate above the black market, the banks are constructing a massive financial firebreak. They are forcibly capturing every available unit of foreign currency, entering the system to build their own reserves.
While simultaneously making it prohibitively expensive for local citizens to convert their rapidly depreciating fiat into hard form currency.
It is a defensive hoarding mechanism. And the collateral damage to the average citizen is catastrophic.
Yeah, the sources issue a very stark, specific warning for July 2026. They point to the implementation of a new real estate ID system, dropping concurrently with massive forced rate hikes by these local banks.
Because the local banks are compelled to hike rates to defend their currency against the Fed's vacuum.
And the downstream effect is brutal. The text projects that domestic floating loan rates will gap up to 17 or 18%.
Yeah, 18%.
For the highly leveraged middle class, sitting on variable rate mortgages tied to historically overvalued real estate, a spike to 18% isn't just financial pressure.
Well,
It's the mathematical liquidation of their entire net worth.
it forces a massive transfer of assets from the leveraged class back to the liquid institutions.
So we've mapped out the entire anatomy of the trap here. We have the inescapable $34 trillion pincer.
Yep.
We've got the psychological operation of the shiny roof masking the collapse of the real economy.
Right.
And the dollar acting as a global vacuum cleaner, forcing local loan rates to levels that ensure mass defaults.
It's bleak.
It is. So the immediate practical question is, what is the countermove? How does the author suggest an individual actually navigate an environment that's literally engineered for their financial liquidation?
Well, this is where the documents pivot from macroeconomic theory to a highly tactical survival playbook. They call it the sniper closing protocol.
The sniper closing protocol.
Yeah, and the foundational, uncompromising directive of this protocol is the achievement of an absolute leverage ratio of 0.
Meaning total divestment from the credit system. No mortgages, no margin, no auto loans.
Complete independence. The protocol demands a merciless withdrawal from all speculative paper theaters. The sniper must liquidate all equity portfolios, abandon speculative digital assets entirely, and exit all debt-fueled real estate positions. You basically have to reject the media's soft landing narrative and voluntarily submit to total financial isolation from the matrix.
And the sources offer a very specific landing pad for all that capital extracted from the paper system. They advocate converting all surplus fiat directly into what they call the physical gold standard.
Yes, but they are remarkably particular about the format.
Right. They actively discourage accumulating massive serialized gold bars. Instead, the mandate is to acquire small denomination, 900,9999 pure gold rings.
And the specificity of the rings reveals the true nature of the strategy. It's about achieving what the authors term ghost mode.
Okay, let's break down the mechanics of ghost mode. Why do small gold rings offer superior systemic protection compared to, say, traditional bullion or even offshore bank accounts?
Well, consider the structural vulnerabilities of the paper assets we discussed earlier. Your brokerage account, your bank deposits, your algorithmic crypto wallets.
Right.
They all fundamentally rely on a central authority or a counterparty to validate your ownership and process your transactions.
True.
So if the underlying institution fails, or if a regulatory freeze is initiated, your liquidity evaporates instantly. Furthermore, paper assets are entirely transparent to administrative scanners and automated taxation algorithms.
But a 9999 pure gold ring sitting in a private, offline safe, well, that completely bypasses that entire infrastructure.
Exactly. It carries zero counterparty risk. It requires no digital validation from a central bank to facilitate a transaction.
And crucially, because it's an untracked sub-reporting threshold physical asset, it renders the holder completely invisible to the systemic failures breaking the rest of the economy.
You effectively step off the game board entirely.
And the small denominations ensure divisibility, right? If
Yeah.
you need to transact locally without liquidating a massive portion of your net worth all at once.
Exactly.
Now, the sources outline a very defined timeline for this sniper strategy, targeting a specific endgame window between 2027 and 2029. Why that specific window?
That window represents the mathematical culmination of the structural collapse we just mapped out.
Okay.
By 2027 to 2029, the massive wall of sovereign debt rollovers converges with the explosion of commercial and retail non-performing loans. The system is basically forced into its final liquidation phase.
So the theory posits that while the general public, the people trapped under the shiny roof, and these highly leveraged corporations are wiped out in this forced liquidation, the sniper remains entirely untouched.
Right, they sit offline, holding undegradable, untrackable purchasing power, just waiting out the systemic margin call.
They allowed the engineered volatility to consume the paper wealth of the overleveraged.
Yes. And when the fiat illusion completely fractures tangible, productive assets, infrastructure, industrial land, energy production, those will inevitably be thrown into emergency court liquidations.
And because the sniper holds physical gold, which is an asset class that historically skyrockets in relative purchasing power during severe currency debasements, they can finally step out of ghost mode.
Exactly. They re-enter the market to acquire these diamond-tier assets at deep, fractional fire sale prices directly from the bankruptcy courts.
It is an incredibly ruthless, infinitely patient strategy.
It really is. It requires a complete decoupling from societal consensus and absolute trust in the underlying mathematics of debt collapse.
Well, we have covered an immense amount of complex structural theory today.
We definitely covered a lot of ground.
Yeah. So to quickly synthesize, we analyze the Federal Reserve not as the master of a resilient economy, but as an institution paralyzed by a $34 trillion mathematical pincer.
Right, forced to choose between a sovereign rollover crisis and hyperinflationary debt monetization.
We dissected the shiny roof media apparatus, which is designed to keep retail capital locked in paper derivatives, while institutional money secures physical assets, all masking the collapse of the real productive economy beneath it. And
we examined how the yield-driven strength of the U.S. dollar drains global liquidity, forcing defensive local banking algorithms that will push domestic floating rates to a catastrophic 18%.
And finally, we detailed the off-grid mechanics of the sniper protocol, achieving zero leverage and hoarding 9,910 and 99 pure gold rings to exploit the inevitable 2027 to 2029 liquidation window.
The entire document serves as a profound, mathematically backed rejection of modern financial engineering.
It really does. And for you listening, whether you find this thesis alarmist, prescient, or somewhere in between, engaging with these mechanics forces a vital stress test of your own assumptions.
Oh, absolutely.
It compels us to look past the daily headlines and scrutinize the true nature of fiat money, the hidden structural costs of infinite debt, and the actual foundational health of the global economy.
This raises an important question, though. In an environment entirely saturated by algorithmic trading and public relations filters, your capacity for independent critical thinking, your ability to independently audit the macroeconomic math, well, that is unequivocally your most vital asset.
It is. I want to leave you with one final thought to explore on your own. We discussed the ultimate objective of the sniper, right? Deploying hoarded physical gold to purchase real-world diamond-tier infrastructure out of court liquidations between 2027 and 2029.
Right.
But if the global systemic fracture is truly as severe as these sources predict, if the entire paper matrix genuinely collapses, what will the societal concept of value or wealth actually look like?
That's a dark thought.
Right. If the financial institutions that currently enforce property rights and legal claims are wiped out, will acquiring a deed to an asset during a fire sale even carry weight in a post-liquidation world?
It completely challenges the very definition of ownership when the systems that validate that ownership no longer exist.
Exactly. So when you step into that beautifully staged open house next time, remember to shine a light on the foundation. Thank you for joining us on this deep dive. Keep scrutinizing the mechanics, keep stress testing the narratives, and never stop questioning the consensus.